Welcome back to the channel. Today is tip number 3. Maximize your retirement saving. This is our 9-part series on essential tax move. If you caught up on our last video, adjusting your W-4, you learn how to fine-tune your paycheck to save on taxes. So now let's take it a step further. In this quick tip, we'll show you how to maximize your retirement savings before year end so that you can cut your taxes and build a long-term wealth. Watch that W-4 video above if you missed it. So step number 1, review your employer-sponsored accounts. If you're employed, start with your 401k or 403b or Thrift Saving Plan or TSP for those who are government employees. For 2025, you can contribute up to $23,500 plus an extra $7,500 if you're 50 years or older. Increasing your contributions before December 31st can directly lower your taxable income, meaning you pay less in taxes this year. Step number 2, fund your individual retirement accounts or IRAs. Review your IRAs, whether it's traditional IRA, Roth IRA, or self-directed IRA. You can contribute up to $7,000 or $8,000 if you're 50 years or older. But keep in mind, these options have income eligibility limits so check the IRS rules to ensure you qualify. Traditional IRAs may offer tax deductions now, while Roth IRAs grow tax-free for the future. Step number 3, for small business, they have even greater options. If you're self-employed or you own a small business, you have very powerful options. For example, SEP IRA or Simplified Employee Pension Individual Retirement Account allows you to contribute up to 25% of your net earnings or your profit for a maximum of about $69,000 in 2025. Simple IRA allows you up to $16,000 plus $3,500 catch up if you're 50 years or older. Solo 401k, on the other hand, lets you save both as an employer and employee up to about $70,000 for 2025 or $77,500 with catch up. These plans can significantly cut your taxable income before year end. There are still other additional tax advantaged accounts like HSA or health savings plans that allows you to contribute pre-tax money while taking advantage of the deductions. HSA, for example, it's a triple tax advantage account offering deductions, tax-free growth, tax-free withdrawals if you use the money for medical expenses. And if you have max on your retirement plans, consider a brokerage account for flexible after-tax investing. So, take a few minutes before December 31st to review, adjust, and maximize your retirement savings. You reduce your taxes today and build a stronger financial future tomorrow. Up next is tip number 4. We'll discuss about harvesting capital losses, another smart tax strategy. So stay tuned and subscribe for a more practical year-end money tip.